What's up, guys? Last video on Foot Locker. I just did another one last week, and I've been thinking about it a bit more, and just wanted to tell my final conclusion on this, and also relay an example of Bed Bath & Beyond that might be relevant to this situation and might give us an idea of what's in store for Foot Locker at some point. So I'll try and be quick on this one. First off, the Bed Bath & Beyond, as a lot of you probably know, they've been having serious troubles over the last number of years. And this chart was brought up by SC from the Punch Card Discord chat. So thanks, SC, for pointing this out. I think this might be an example of what's in store for Foot Locker. As I said in the last video, I think this is a bit of a race. It's a race between the buybacks and the business deterioration. So Foot Locker, what they did is their sales are supposed to decline by 5% this year, roughly. But they've also bought two new businesses. What are they called? Atmos and WSS. They bought those in 2021, and even with these purchases to try and slow the rate of decline, they're still declining by 5%. So I don't think that's a very good sign. I believe the company's in terminal decline. I don't think that they have a defensible moat online compared to Nike or let's say Adidas, if they just try to sell their gear directly to consumers. But to compare to Bed Bath & Beyond, so as you can see, they've done substantial buybacks for the last 10 years or so. And the revenue really started to flatline in 2017 and then decline in 2018-19. And so you can see that really had an effect on the stock price because the stock market absolutely detests stocks that don't have growth, and it really hates stocks that shrink. So we have a situation where the stock fell down quite a bit. I don't know even what percentage that is, but it finally bottomed in the COVID crash, and there was one last smoke left in this cigar, which was at that point, and it was up another. I actually don't know what the percentage was there because I forgot to put the the prices on this chart, but there was one last smoke left in this. But the problem was there's two problems here, and they're both related to transactions. So in order to get this last smoke, you had to actually know when the bottom was, which is, some would say, impossible when you're in the middle of it. Like, is this the bottom for Foot Locker, or is the bottom 15? Is it 12? Is that coming? So you really need to be picking bottoms or close to it. And then also you need to know when to sell. You need to know when the last smoke is done so you can get out because you can see it rolled over again and has been coming down. So you have to be really on this. You probably have to be a pretty good trader to do this if you believe there's terminal decline. The other thing I would mention is it's now trading, I think I said this in the last video, but it's trading at, I think, 7 times projected free cash flows for this year. That may seem cheap, but if that's only cheap if you have growth. If you have a company that's growing, 7 times free cash flow is a great deal. But as you can see with another stock that I follow, Teva, that actually isn't in terminal decline. It's in temporary decline. That thing's been trading at 3 to 4 times cash flows for a few years now because their revenues are just grinding lower as they try and find their footing on some of this other stuff. But that one's projected that the growth will pick up again, and that's still trading at 3 or 4 times earnings or cash flows. And for Foot Locker, it's possible that this goes much lower. I could see it going down to 3 or 4 times free cash flows if the I'm not projecting that, but I'm saying that could happen. So don't assume that it's cheap because it's 7. So I guess my conclusion is pretty obvious here. This is a no for me. I'm not interested in the stress. I'm not interested in having the clock ticking in the background on this one, because that's basically what's happening. It's a race against the clock. And I prefer stocks where I just know I'm buying cheap, and over time, it should revalue towards its intrinsic value. So one thing I would mention here is if you're looking to buy Foot Locker, if this is something you're in, I would suggest having very clear guidelines of when the thesis is wrong, right? So you know when your exit strategy is, and also like, so if this happens, that means I'm wrong and I need to get out whatever the price is. Or if I'm right, then what's the upside here and what's my exit strategy on the upside? Because I think, like as I pointed out with Bed Bath & Beyond, you really needed to time that thing right, and you really needed to have a plan. So if you're in the stock, I wish you good luck, and I'll keep an eye on it just because I'm curious as to what happens. But for me, it's a no. I think there's lots more interesting things in the market now, especially since the last 2 weeks. A lot of stuff has come down to much more interesting levels. So I've got 20 better ideas, maybe 40 better ideas than Foot Locker at the time, or right now. Anyway, thanks for watching, guys. I hope you have a great day.